Hello everyone, and thank you for watching this weekly technical outlook video here at xm.com. It's Monday, September 4th, and at this video I will share my view on three key markets: Aussie dollar, dollar loonie, and gold. We have two central bank policy announcements this week coming from Australia and Canada, while gold could also attract significant attention given its recent rally in commodity markets. So starting first with the Australian dollar versus the US dollar, the Reserve Bank of Australia is expected to hold interest rates steady this week. Basically, investors are actually waiting to see whether the tightening phase will end this month, not only Australia, but also in other major markets. But given the still elevated inflation numbers, I don't think that the Reserve Bank of Australia could announce the end of its tightening cycle. So it would be interesting to see what could keep the central bank hawkish in the coming months. What could still, what could be what could justify another rate increase in Australia, given the negative economic developments in China. That could be a negative external risk to Australia. We also have Australian GDP growth numbers coming out this week. China's inflation and trade data could also be important for Aussie dollar. So what we are waiting to see in this market is whether the Aussie currency will manage to overcome the 0.6480 nearby resistance against the US dollar. If that happens, if that rebound over here continue above that level, the next obstacle could emerge somewhere between 0.6570 and 0.6615, where the price peaked back in mid-August. The 50-day moving average is also within this region. So what could improve the short-term outlook in this market is a decisive rally above this resistance line coming from April 2022. That's currently seen around 0.68. So we need to overcome that bar in order to rally towards the important barrier of 0.69, where the price peaked in June and July. But that's still long way up, and we will need continues, either improvement in China's economic situation or a relatively hawkish central bank, and apparently better domestic data. But from a technical perspective, the risk is still skewed to the upside. We can see an ongoing improvement in technical indicators. So if the price fails to overcome the 0.6480 zone, we may see another battle around this support trend line coming from 2020 low of 0.55. That's around 0.64. So failure to hold above that territory could trigger a fast decline down to 0.6280, where the price bounced up in November 2022. Now turning to the US dollar versus the Canadian currency. The Bank of Canada is also expected to hold rates steady, but compared to other major central banks, I think the Bank of Canada it feels more comfortable in turning into a wait and see. In adopting a wait and see approach, given that inflation is closer to its range target of 1 to 3%. So a wait and see mode in Bank of Canada could be reasonable this month. Technically now, the loonie is still facing downside risk following the rebound on the 20-day moving average, but looking to the upside, the US dollar could face some key barriers around the 1.3640 level, and then higher. This descending trend line from the 2020 top could be another significant obstacle at 1.3730. So we need a decisive rally above those boundaries in order to become more optimistic that this uplift will continue. Now, if you look at the RSI and the stochastic indicators, the indicators have bounced up, so that keeps the risk on the bullish side. However, if the price fails to overcome the 1.36 territory, we may see a downside reversal towards the 20-day moving average. That's around 1.35. This is also the 50% Fibonacci retracement of this down leg over here. Then below that, the 200-day moving average at 1.3460 and perhaps the 38.2% Fibonacci mark of 1.3430 could be another interesting area to watch before we ease towards the upper band of this broken bearish channel where the 50-day moving average is currently heading. And finally, turning to gold, gold had a nice rebound in August despite the strength in the US dollar and the rise in US stock indices. The ISM non-manufacturing PMI will come out this week as well on Wednesday, so that could provide more update, that could provide more clues about the strength in the US economy. Now, from a technical perspective, we can see that gold is still trading around the upper band of this bearish channel. It hasn't closed significantly above that, and more importantly, it's still below the 61.8% Fibonacci mark of the short-term downtrend, which is at 1948. So technically, we need to rise above that boundary before we target the 1965 resistance area, where the 78.6% Fibonacci mark is also located. Then, if we continue above the 1977 mark, where the price closed in July, we will probably see an extension up to the important 2000 mark, a break of which could clear the way towards the 2050 key boundary, given that there are no major obstacles until that point. Fundamentally, if central banks ease their hawkish tone and potentially signal a pause in monetary tightening, that could help gold if growth risks also increase. If that doesn't happen and the price also, stays remains within this bearish channel in the short term, we may see a downfall towards the 20 and 200-day moving averages. Those are currently at 1915. Slightly lower than that, the 23.6% Fibonacci mark of 1910 could be also a key support region, a break of which could drive us down to the 5-month low of 1884. We can see that the 20 and 200-day moving averages are set to post a bearish cross. That could be a negative trend signal for the market. And the outlook could get even worse if the 50 and 200-day moving averages also post a negative death cross. But so far, we have to wait a bit before that takes place, before we confirm that this could happen. In the meantime, we will be looking whether gold can overcome the 1935 level, which is the 50% Fibonacci, and whether it can also close above the 61.8% Fibonacci mark of 1948. So that's all for this week's key pairs that might attract attention later this week. Thank you for watching, and see you next time. Bye-bye.